Thank you.
I'm Alan Dent, partner at Deloitte, and this is my colleague David Morgan. So we'll just take you through a summary of sort of where we've got into in relation to the peer review work that we've been engaged to assist council with. As has been touched on by sort of Dr. Pearce, there are still some elements of the negotiations that continue, and that obviously sort of dictates a little bit what we can sort of talk about in this session today. In terms of sort of what we'll talk to, really, what we're trying to achieve this afternoon, the scope of the work that Deloitte has undertaken, how we've gone about the work we've done, what the business case currently looks like, very high level of some of the investor terms, some of the risk, what the financial returns to HBRC look like, some of the risks and some of the evidence around water uptake and sensitivity analysis. But really to sort of provide an update as to where we're at and sort of help people with their deliberations this afternoon. So getting to what we've been asked to do, essentially review the latest version of the financial model that supports the business case for the investment in the RWSS, make sure that we understand how that model works and in particular the calculation and the allocation of financial returns to the different investors, including HBRC, to make sure that we understand the key assumptions that sit behind that financial case, confirm the water take-up break-even point, and then undertake some sensitivity analysis to demonstrate the impact of different water uptake on the returns to HBRC as an investor. Part of what our work has involved has been making sure that we understand how the assumptions in the financial model tie back to the capital expenditure assumed in the design and construct contract, i.e. the contract that dictates what's involved in building the dam and distribution network. Then again trace the investor assumptions that are incorporated in the model, in the financial model, back to the different investor term sheets to make sure that they're accurately captured so that the financial returns from this investment are correctly calculated in accordance with the terms that have been agreed or in negotiation with the different investor sets, and then obviously and importantly to test the basis for the water uptake assumptions that are included in the financial model. We note that there are still some elements of the project that continue to evolve. That's entirely consistent with what happens with major projects of this nature, where essentially as things move towards the conclusion and financial close, various elements of the project come together, but it's really not until you get absolutely to the final date that everything is finalised. But clearly, the expectation now is that that the project is sort of materially advanced towards financial close, and as has been indicated by Dr. Pearce, clearly if there are material adverse changes, then those have to be brought back to council for consideration. Since we undertook our initial peer review of the business case for the RWSS in 2014, since that time, obviously, a significant amount has happened. What we're talking through here are some of the major changes to the business case from that which we reviewed, a couple of years ago now. Has been touched on by Dr. Pearce. The total upfront construction and financing costs have increased by around about $50 million. About $37 million of that increase relates to the construction cost of the dam. But a related point that a greater portion of that construction cost for the dam is now on a fixed time, fixed cost basis. That essentially de-risks the project materially from the risk to HBRC and the other investor sets of cost overrun through the construction of the primary asset and the majority of the distribution system that goes alongside that. Provisional terms have been negotiated with a sub-debt provider, whereby it would provide subordinated debt to assist with the funding of the project and through the initial water uptake period. Similarly, provisional terms have been agreed with an institutional investor to provide approximately 50% of the equity required to fund the project. So if we go back to 2014, one of the major sort of gaps at that point was the ability to identify and bring into the project an institutional investor to sit alongside HBRC. Another key change is that bank debt will now be used to fund a substantial portion of the upfront capital cost of the project. Similarly, and linked to the additional capital cost, the catchment area for the RWSS has been expanded to include an additional approximately 5,000 hectares by including an additional area in the area to be serviced. A key point, but I think which is particularly relevant when benchmarking the expected return from the project, is that the interest rate environment has changed very materially over the last couple of years, with interest rates at materially lower levels than was the case 2 years ago. That does impact on investor required rates of return. It brings them down. The project now has a substantial volume of water contracted. In the first, as has been touched on by Dr. Pearce, the first irrigation season post-construction has been moved out to 2021, which is later than was targeted in the 2014 business case. The table below sets out just how that construction cost comes together, what the component pieces are. Clearly the dam and the distribution networks being the major components, and you can see the movement in the construction cost for the dam. Slightly lesser but significant movement in relation to the distribution network, and more modest movements around some of the other component parts. But movements again in relation to development costs, and significantly financing costs because of the decision to fund the upfront capital with a substantial portion of debt. There is now interest incurred on the way through that gets bundled into the capital cost of the project. Previously, the project was to be funded by the equity providers, who also would have had a required rate of return or a return on their investment, but that cost wasn't brought into the mix when quantifying the total capital cost of the project. Just elaborating a little bit more on some of the key capital cost changes. As I've noted, the increased dam and distribution costs, partly that comes from the additional 2 years inflation and adverse foreign exchange movements. There's also an increased percentage of total capital, as I've mentioned, on a fixed time, fixed cost basis. That's a risk sharing mechanism, obviously with a lot of risk transferred back to the contractor, but that comes at a price. There's a greater proportion of the cost a materially greater proportion of the cost of the secondary distribution is now included in the fixed time, fixed cost element of the DNC contract. The irrigation footprint, as I've mentioned, is expanded from 23,000 hectares to 28,000 hectares. There's a higher specification distribution system incorporating higher pressure and additional pumping stations. Increased development costs due to the delay in financial close and legal proceedings. Under the current proposal, there won't be a hydro generation station included in the structure, but the structure will be developed in a way that the option to retrofit a hydro generation facility at a later stage is retained. And obviously costs remain uncertain, but it potentially provides a hedge for costs if electricity prices increase significantly from current forecasts. And as I've mentioned, there's now the introduction of senior bank debt, which brings in with it clearly additional fees and interest during the construction period. Operating and maintenance cost assumptions have been updated since 2014. The O&M cost now in the current model compared with 2014 are set out in the table below. So you can see the movement there. A major component of that is the increase in energy costs, because under the previous proposition with generation embedded in the scheme, there was a substantial portion of the cost of electricity that was met by power generated by the generation capability of the scheme, which won't be there at day one now. And in addition to the ongoing operational costs, for energy, the upfront capital cost will be repaid over time, including a margin to reflect a regulated rate of return in relation to the delivery of power. As I say, the major changes in assumed costs relate to the increase in scheme energy costs, due to the removal of the hydro generation and the increased scheme footprint, increased distribution costs due to the higher number of pumps in the secondary distribution network, increased mitigation consenting costs as a consequence of the Board of Inquiry requirements, and increased costs with central lines due to an expanded control zone and associated increase in costs to service a larger network. From an HBRC point of view, it's possible to potentially subcontract elements of the O&M back to related parties, which should provide some risk mitigation. There's a price reset mechanism in the water user agreement that if revenue and cost growth diverge by more than 0.25%, there's an ability to reset to provide some protection around unanticipated cost growth. And there is the ability to hedge electricity price risk through fixed price and variable volume electricity supply contracts. So those are decisions for the scheme to make at an appropriate point in time. Set out below on this diagram is the rate of water uptake that's assumed in the current business case. Clearly, the rate of water uptake is the primary driver of revenue, and you'll see how that works through. We understand that as at today, there is, I believe the number is now just under 43 million cube of signed water agreements, or user agreements, with another 3 million expected to be signed today or very shortly. There's also 1.3 million cubes related to volumes which may be contracted by Central Hawke's Bay District Council, and 4 million cubes which is under public consultation by HBRC, and a further 2.4 million cubes which are well progressed. At full uptake, the assumption is that there'll be 100 million cubes of Class A contracted water, 1.6 million of CHBDC water, and HBRC contracted water of 4 million. Clearly, there are things that need to happen before that gets locked down and is agreed. But essentially, the volume of assumed contracted water is 105.6 million cubes. In addition to that, there's an assumption that there will be spot water sales on average of 8.4 million cubes per year. Clearly, that will fluctuate depending on sort of conditions on an annual basis. Trying to sort of translate that into financial terms. In nominal dollar terms, revenues from the sale of contracted water in 2031, assuming full take-up, will be just under $40 million, with an addition to that of spot sales of 3.3 million. That would drive a gross margin, so pre-interest costs of around about 31.5 million, but after deducting operations and maintenance costs of around about 11 million in 2031 year dollars. At the moment, the investment structure is a combination of senior debt and subordinated debt. That brings in roughly 180 million of the capital cost of the scheme. Institutional investment of very slightly under 80 million, alongside HBRC equity of 80 million, so essentially 50-50 split, and a combination of an element of sort of the SP3 funds, which is for the element of the distribution scheme that isn't covered by the fixed term contract of around about 5.3 million funded from operational cash flows. Key features of the investment structure are a substantial component of senior bank debt, somewhere in the vicinity of 80 to 100 million of subordinated debt, clearly still, and then capital sourced from an institutional investor, essentially matching the level of HBRC investment. Key changes to the financing structure since 2014. Clearly, as I mentioned, a change in the potential investors, including the addition of an institutional investor that has substantially the same risk exposure, excluding demand risk as HBRC. Reduction in the fixed investor fee, which means the institutional investor shares more take-up risk than was previously the case, and the addition of bank debt from financial close. In terms of how that capital plays out, HBRC's capital is drawn down first, followed by the subordinated debt, the bank debt, and then finally the institutional equity comes in as essentially the last cab off the rank to fund the balance of the project. In terms of break-even, there's extensive analysis has been undertaken to determine the water take-up point at which different cash flow requirements are met. This analysis has been provided by HBRC's financial advisor. That analysis shows that the break-even point for the project is at a water uptake volume of 41.5 million cube, but importantly, break-even is assessed to be the point at which all fixed cash commitments of the project are covered. It's not the point at which all investors have their required rate of return expectations met. So, for the sake of absolute clarity, fixed cost commitments comprise the obligations to the senior debt provider and the obligations to meet the O&M costs of the scheme. After this take-up level, cash becomes available to meet the requirements of the providers of risk capital, so the subordinated debt providers, and then, in sequence, the equity capital providers. In terms of where water uptake sits today, and this is, has been moved slightly since these slides were prepared, there's now, I think, 42.8 million cubes, 42.6 million cubes of signed contracts, another 3 million or so that's in the process of awaiting final signature, another 2.4 million cubes at an advanced stage of negotiation, and also call options for water user agreements have been agreed of around about 2 million cubes. That sums to around about 50 million cubic metres. In addition, there's the potential for additional CHDC flows of 1.3 million and the 4 million cubes of sort of HBRC flows. The contracted volume does include 300,000 cubic metres for the CHBDC flows that have already been contracted, but the contracted volumes don't include the HBRC volumes because they're still subject to public consultation. And as noted, call options have been signed by parties that want access to water, but have yet to, and want to reserve the right to contract at a later point. In terms of how that water uptake curve has moved, the blue line shows what was assumed back in 2014. The green line shows the assumption in the current model. Essentially, that reflects the benefit of the fact that we're now sort of 2 years further down the track of sort of of progressing water uptake. But clearly, it's a major driver of financial performance from the scheme, and so set out below are some of the scenarios, what happens under different water uptake scenarios. So a faster uptake, which is the green line, would take you to 100% after 8 years after financial close. With slower uptake, the light green line at the bottom, showing uptake not being achieved till the 20th year after financial close, relative to the base case, which is 15 years. And so setting up as those really just, the break-even of irrigation flows under the current case, showing where we sit, where it's assumed that people will sit by 2020, and then sort of progressively forward as the scheme advances, showing the combination of sort of the majority of water obviously being secured under Class A contracts, potentially a component under HBRC and the Central Hawke's Bay, groundwater consents, converting to formal contract for the duration, and then an element of spot water sales, capping out at the sort of around about 115 million cubes. In terms of uptake evidence, clearly it's because given the nature of the project, it's the area that's sort of the major driver of sort of financial performance. In that context, HBRC, the institutional investor, and the subordinated debt provider have all undertaken very extensive due diligence to assess uptake risk. Now, clearly, in that context, considerable work has been undertaken by HBRC to validate uptake assumptions. That work has included, building up a bottom-up water demand model based on a database of farmers within the catchment area, rerunning previous advice provided by Macfarlane, farm advisors on farm financial feasibility, and also commissioning a separate piece of work around on-farm financial feasibility, and then undertaking extensive analysis of approximately 20 different farms for soil type, climatic risk, etc., to assess the likely farming systems that would be viable under, with access to reliable water. In addition to that, the subordinated debt provider and the institutional investor have both commissioned their own independent assessment of demand for water. Though, collectively, 3 separate parties have undertaken analysis of the project and have confirmed views that it's reasonable to assume that there will be sufficient demand for water. Those parties are independent of HBRC and its advisors, and independent from the institutional investor and subordinated debt provider. That said, while the analysis undertaken by HBRC and the investors support the assumption there will be demand for water from RWSS, and that full uptake over time does represent a reasonable assumption, clearly uptake remains the key project risk. In terms of HBRC's returns, we have modelled extensively the impact on returns under different scenarios. Under the current case, a post-tax investment rate of return of 6.5% is calculated, and then you can see through the scenario summary below the impact on that return under different uptake scenarios. So if uptake caps at 7.5%, at 75%, that drops to 5.5%. At an upside scenario, that increases to 6.7%. Clearly, all of the return calculations are based purely on the cash flows that are modelled for the project. Typically, in a public sector business case, you would also factor into the calculation costs that are avoided by virtue of the project, which Dr. Pearce alluded to. What the sort of order of magnitude potentially of those costs. But clearly, if those our calculations show that for every $10 million of avoided cost, the return on the project increases by about 0.5%. And then just to sort of reinforce that the diagram below really shows that sort of 75% is a key of water uptake is a key point. At and beyond that point, HBRC starts to generate a more attractive return, getting around about that 5.5% at 75%, and then trending up to 6.5% as you head towards full uptake. We haven't, in terms of our analysis, because we've primarily been heavily focused on risk, we haven't modelled any upside scenarios other than a scenario whereby full uptake is achieved earlier in the project life, though there are other upside scenarios that could be constructed. As mentioned, though, the key sensitivity is is that 75% uptake. That beyond that, the project is in pretty good shape from an HBRC investment perspective. So because at that point it really does start to get an acceptable share of the cash flows of the project, and obviously they improve as you head towards that full uptake position. Sort of further comment that while there is clearly always refinancing risk, given that there's a substantial tranche of debt now incorporated in the model and the financial case, in our view the assumptions in relation to bank debt are relatively conservative, so do provide a reasonable level of protection against sort of unwarranted or unanticipated step up in the cost of sort of term debt financing. And those diagrams really just show how cash flows play out under different scenarios between the different investor sets. And that's pretty much where we stop.
Thank you. Okay. And thank you very much for those two presentations. A fair bit of information.